Hi, this is Mark from Right Line Trading, and I wanted to review some of the principles that we use to trade our software system, and appraise you of the significance of our indicators, as well as alert you to a trade that's shaping up on the Russell, a bullish trade, in which there's the potential for the Russell to go up and make a very strong move to the upside. Now, before I do that, I want to show you some of the previous moves that the Russell has made and how accurate the software has been in picking those up. The first move to the upside occurred at 1024.13. Now, what you can see here is the market moves up, buyers control. Then on the B candle, on this all prints on the charts automatically by the software. The B candle, sellers tried to push the market down. They failed. Buyers came back in and engulfed them to the upside. Entry criteria for the B candle, for the C engulfing candle, were met for an entry, and they include you must be above the 50. This is a 50 period simple moving average. You must be above the right line trend line, which must be green, and this proprietary trend line had a nice angle, nice slope to the upside. And if you look down at our 3-line indicator, first line is order flow direction, second is stochastic direction, third is momentum direction, and those 3 parameters are being assessed on multiple time frames. So this is multiple time frame analysis of order flow, stochastic, and momentum direction. Now, the lowest indicator looks at order flow asymmetry, and I will talk about that indicator in a minute. Now, taking a look at this trade, the C candle engulfed to the upside with order flow, stochastic, and momentum in its direction above the 50 and above our proprietary right line trend line. The close of the candle was 1,116.2. The entry would have been 0.3. The high was 1,118.2. Actually, it was a 19-tick trade, and this occurred intraday. It was a very strong intraday move, and took place over a period of about an hour and about an hour and 20 minutes. So, in the space of an hour, we had a nice 20-tick trade. Now, on a 21 range candle, which is what we're trading on this chart, you would be in 1 tick above the close, and your stop will be 1 tick below the wick. So you're taking 22 ticks of risk on this trade to make 20 ticks of profit. Now, the same setup occurred. It was similar. It's a little bit riskier, but market structure is such that it was definitely a worthwhile trade to take. Now, we like to see the right line trend line green. That's optimal. But we're above the 50 period moving average. Again, the market moves up. Sellers come in to try to push the market down. They fail. They get caught in an engulfing candle to the upside as buyers come storming back into the trade. You look down and you can see that at the close of the C candle, you have order flow, stochastic, and momentum on multiple time frames, again in your favor. Now, this creates 2 impulses pushing your move to the upside. The first is buyers continue to pile into the trade, and the second is that all of these sellers in this failed counter trend move are all swamped and begin to get stopped out. And as they're stopped out and their contracts are covered with buy orders, it serves to push the market up even harder and make this a very, very low risk trade with a strong predictive value for being successful. The entry on this candle, this is on 1025, would have been at the 1 tick above the close. 1,116.7 was the close. 0.8 is your entry, and the high was 1,120. That's a 32 tick trade, and that evolved over a period of about 60 minutes for 32 ticks. Now, we didn't get a similar setup or an entry setup that met the right line trading rules until 1028. And on 1028, we get a candle that breaks the 50 period moving average to the downside. Now, the right line trend line is red and pushing down. And if you look down, you can see that order flow, momentum, and stochastic are all red. And importantly, that's signaled on the candle, which is now circled by yellow, telling you without even looking down that you have order flow, momentum, and stochastic all in your favor to the downside. So on this break of the 50, we've got a three-line signal. The close of the candle is 1114.3. You're in at 0.2. The low of the move is 1109.9. That's a 43 tick win. Now, throughout this entire time, there's no other potential trading setup based on our rules. So no losers. A win here, a win here, a win here, and now we have another potential trade setting up right now. Now again, buyers have come in and pushed the market up. Sellers have tried to reverse the direction of the market, and you can see that it comes with an order flow asymmetry signal, this orange line. Order flow asymmetry means that the sellers are asymmetrically dispersed throughout the candle, and most of the sellers are located at the bottom of the candle. Now, that's bullish if you're going to go long. With most of the sellers in the previous failed counter trend move located at the bottom of the candle, they're going to get stopped out even faster. Now I'm trying to adjust this line here. But here is where most of the sellers are located. Now we get the candle that threatens to engulf to the upside. If it triggers us into the trade, the close of the candle would be 1117.5, and we'd be in at 7.6. First target would be 119.6, which would be 21 ticks of profit. Second target would be 1121.1, which would be 36 ticks of profit. Again, this is all based on 22 ticks of risk. I hope you enjoyed this brief overview, and we'll take advantage of this bullish potential entry at 1117.6 that's setting up on the Russell. Thank you.